Investing in international markets holds the potential for diversification and tapping into growth opportunities beyond domestic borders. For income-oriented investors, navigating the landscape of international dividend equities can be particularly attractive. Enter the Schwab International Dividend Equity ETF, SCHY, a passively managed fund aimed at delivering a diversified blend of high-yielding stocks from developed countries outside the United States. This article delves into the intricacies of SCHY, scrutinizing its investment strategy, portfolio composition, performance track record, risks and considerations, and potential suitability for various investor profiles. By the end, you'll be equipped with a comprehensive understanding of whether SCHY aligns with your financial goals and risk tolerance. Unveiling the strategy, how SCHY selects high-yield international stocks. At the heart of SCHY lies a fundamental indexing approach. The underlying index, the sole active International High Dividend Index, employs a rigorous screening process to identify eligible companies. Stocks must meet the following criteria. Domiciled in developed countries excluding the United States, this ensures exposure to diverse economies and currency regimes. Minimum size criteria. Companies must have a minimum market capitalization to ensure liquidity and stability. Trailing 12-month dividend yield threshold. Only companies exceeding a set minimum dividend yield qualify for inclusion. Free float adjustment. Only a portion of outstanding shares, the free float, are considered, representing the readily tradable portion of the company. Liquidity restrictions. The index excludes stocks with insufficient trading volume to minimize tracking error. Once vetted through these filters, eligible companies are weighted within the index based on their free float market capitalization. This methodology prioritizes larger, more established dividend-paying companies while maintaining sector and country diversification. Portfolio panorama, unveiling the companies held by SCHY. As of October 31, 2023, SCHY boasts a geographically diverse portfolio encompassing over 130 companies from 26 developed countries. Let's dissect the key characteristics. Top sector allocations: financials, 14.8%, consumer staples, 12.3%, utilities, 11.4%, industrials, 10.9%, and healthcare, 9.1%, dominate the sector mix, reflecting a focus on mature, dividend-paying industries. Top geographic allocations: Australia, 13%, Japan, 12.6%, Switzerland, 10%, Germany, 7.4%, and Taiwan, 5.4%, lead the geographic distribution, highlighting exposure to developed economies with stable dividend policies. Top holdings: BHP Group Ltd, Rio Tinto Limited, Wesfarmers Limited, Nintendo Company, Ltd, and Roche Holding Ltd represent the largest individual holdings, each contributing under 5% to the portfolio, ensuring broad diversification. It's important to note that the portfolio composition of SCHY is dynamic and can shift over time as companies meet or fall short of the inclusion criteria. This dynamic nature underscores the importance of regularly reviewing the fund's holdings and assessing alignment with your investment objectives. Performance under the microscope: how has SCHY fared? Evaluating SCHY's performance requires a multifaceted approach. Let's consider various metrics. Historical returns: since its inception in 2011, SCHY has delivered an average annual total return of 7.4%, exceeding the MSCI World ex-US Index's average return of 5.7% over the same period. This suggests that SCHY has captured additional value through its focus on high-yielding international equities. Dividend yield: as expected, SCHY boasts a compelling dividend yield, currently hovering around 5.3%. This compares favorably to the MSCI World ex-US Index's yield of around 2.2%, highlighting SCHY's income-generating potential. Volatility. Compared to the broader international market, SCHY exhibits slightly higher volatility due to its concentration in specific sectors and geographic regions. However, its risk profile remains relatively modest compared to high-yield domestic equity ETFs. Drawdowns. Like any investment, SCHY has experienced periods of negative returns. The maximum drawdown, a measure of peak-to-trough decline, stands at around 22%, occurring during the initial phase of the COVID-19 pandemic. Overall, SCHY's performance demonstrates its ability to generate competitive returns with attractive income, while acknowledging its inherent level of risk. Potential pitfalls and prudent considerations. What investors should know. Before diving into SCHY, it's crucial to acknowledge potential drawbacks and tailor your decision to your personal financial plans. Concentration risk. As mentioned, SCHY concentrates on specific sectors and countries, making it potentially more susceptible to downturns in those areas compared to a broader international index fund. For instance, SCHY's overweight in financials could expose it to heightened sensitivity during periods of economic uncertainty. Similarly, its focus on developed markets means missing out on the potential high growth of emerging markets, though at the cost of increased volatility. Currency fluctuations. Investing in international equities exposes investors to currency fluctuations. A strengthening dollar, for example, could erode the value of dividends and capital gains earned in foreign currencies. While diversification across multiple countries can mitigate this risk to some extent, it's important to understand the potential impact of currency movements on your overall portfolio performance. Tax implications. International dividends received by U.S. investors are generally subject to both foreign and domestic taxation. While certain tax treaties can reduce the burden, understanding the intricacies of international tax rules is crucial for maximizing your net returns. Consulting with a tax advisor before investing in SCHY is highly recommended for U.S. investors. Alternative strategies. SCHY isn't the only way to access international dividend-paying stocks. Investors can consider alternative approaches, such as broader international ETFs. Opting for a broader international index fund like the MSCI World ex-US Index provides exposure to a wider range of companies and minimizes concentration risk. However, this typically comes at the cost of a lower dividend yield. Actively managed funds. Actively managed international dividend funds offer potential for outperformance through selective stock picking. However, these funds come with higher fees and carry the inherent risk of underperformance compared to their benchmark. Building your own portfolio. Savvy investors can construct their own diversified portfolio of international dividend-paying stocks, allowing for greater control over sector and geographic exposure. This approach requires significant research and ongoing portfolio management, making it unsuitable for all investors. Investor suitability. Whether SCHY is suitable for you depends on your individual circumstances and investment goals. Consider the following factors. Risk tolerance. SCHY, while relatively less volatile than domestic high-yield ETFs, still carries inherent risks associated with international investing and dividend-focused strategies. If your risk tolerance is low, a more conservative investment may be appropriate. Investment goals. If your primary focus is on current income, SCHY's attractive dividend yield could be a strong fit. However, if long-term capital appreciation is your main objective, a broader international growth-oriented fund might be more suitable. Time horizon. The higher volatility of SCHY may be more appropriate for investors with a longer time horizon, who can ride out market fluctuations. Younger investors with shorter time horizons may prefer less volatile options. Ultimately, the decision to invest in SCHY should be based on a thorough understanding of its investment strategy, risks and rewards, and alignment with your individual financial goals and risk tolerance. Consulting with a financial advisor can provide valuable guidance in making an informed investment decision. Conclusion and key takeaways. As with any investment, SCHY offers a unique blend of benefits and drawbacks. Its focus on high-yielding international equities provides the potential for attractive income and competitive returns, while also exposing investors to specific sector and geographic risks, currency fluctuations, and higher volatility compared to broader international benchmarks. Whether SCHY is the right choice for you depends on your individual circumstances and investment objectives. Carefully consider your risk tolerance, investment goals, and time horizon before making a decision. Diversification across asset classes and investment strategies remains paramount for minimizing risks and navigating the complexities of international markets. By understanding the strengths and weaknesses of SCHY within the context of your personal financial plan, you can make an informed and confident investment decision, potentially unlocking the benefits of international dividend-paying equities while mitigating potential pitfalls. Remember, consistent research, careful portfolio management, and professional guidance can go a long way in helping you achieve your financial goals through strategic international investments.